Good evening, everyone. My name's Jesse Drever. I'm from Leisure Networks. Firstly, I want to begin by acknowledging the Wadawurrung people of the Kulin Nation, the traditional owners of the land on which I'm presenting from tonight. And I'd also like to acknowledge the traditional owners of the land you're all listening in from today. I wish to pay respects to their elders, past, present, and emerging. To give a bit of background on Leisure Networks and the work that we do, we're a regional sports assembly based in the Barwon region, but working really closely with partners around the metropolitan Melbourne area and regional Victoria. We provide volunteer support, training and development opportunities to local clubs, and specifically we support work by the community sport and recreation sector to create inclusive opportunities for people with a disability as a registered NDIS provider. We're really excited to partner with the City of Monash for this club development program and acknowledge the investment made by the City of Monash to upskill their club volunteers and members of the community. And tonight, to start the session, I'm going to briefly pass over to Belinda Griffiths from Council to say a few words on behalf of Council.
Thanks, Jesse. And to those that didn't join us for Stream 1 on Monday night, welcome to you all. We're really excited by the opportunity to work with Leisure Network and deliver, as Jesse said, that the education series for clubs that helps with implementing and ticking off some of those mandatory requirements through the framework that a lot of you would be familiar with. So this is working with you. The sessions are aimed to be interactive so that we can get the most out of it and you can hit the ground running with them. So enjoy the night. I'll sit in the background if there's any major questions or anything like that from a council's perspective, but enjoy the night and thanks, Jesse. And thanks to the guys at Moore. Sorry, guys.
Thanks, Belinda. Look, as Belinda's touched on, this is part of a greater club development program. Stream 2, financial. So the first stream, which we commenced on Monday night, was around governance. And we've got 2 streams being delivered early next year around volunteers and planning. So tonight's session obviously being Financial Management 101. The second session in this series around financial sustainability on the 28th of October. And we finish off the program with the session around sponsorship called Show Us the Money on the 11th of November. If you can go to the next slide, please, Bo. In terms of the content that we're going to discuss tonight, and the team from More Australia will go into a bit more detail shortly, but effectively what we're going to do is understand basic financial terms and components of managing a community sports organisation. Particularly, obviously, most of you, if not all of you, are set up as incorporated associations, so you'll have some common characteristics and obviously obligations that under legislation in terms of how you are managed financially from that perspective as well. Secondly, we're going to go over increasing your confidence and understanding in setting a budget, as well as increasing awareness of auditing requirements. And lastly, increasing your knowledge of reporting and managing a balance sheet. Next slide again, if we can. In terms of, we've got this just as team rules, but just some quick notes for tonight's session. Firstly, the session is being recorded. For those that were with us on Monday night, you might have already seen the recording from that session. Your faces won't appear in any recording. It is purely focused on the actual slides themselves and the audio that's coming through. But if you do have any issues with, if you are making comments throughout the session and you prefer not to be included in any recording, please don't hesitate to let us know and we can edit that recording to cut out any part of audio that you're not comfortable with being shared. We also said at the start, if you can please put your microphones on mute just when you're not talking. But as Belinda said, we want to make this session as interactive as possible. So if you have got a question, by all means, either put it within the chat box itself at the top of the screen, or if you have any issues with the chat or you want to kind of, I guess, expand on some of your comments a bit more, please feel free to take yourself off mute and join in the conversation at any point. Lastly, I do want to say, obviously, we're going to have varying knowledge and experience in terms of financial management joining us as attendees tonight. So within that, in terms of asking questions, if there's anything that you don't understand that the team from More Australia don't kind of touch on, please feel free to ask a question. No question's a silly question tonight. We want to really make sure that no matter your experience within sport, no matter your experience in terms of managing finances, that you still do get a lot out of the session in terms of, I guess, managing a sports club. So please feel free to ask any questions that come up throughout the content itself. I might just get Bo to pass on to the next screen before I introduce them. So the relationship that we have, Leisure Networks, with More Australia, we've worked really closely with them for a number of years now, and the purpose of our relationship is to make sure that community sport get the expertise from the experts in the area of finance. So we work closely with Harwood Andrews from a governance perspective. They're a legal firm, and More Australia from a finance perspective. So obviously the experts in the field, and in terms of the relevance, in particular with some of the work that we do with them with community sport, that they've delivered a number of workshops with us over the years, and they've also helped us more specifically with drafting strategic plans for clubs. So they've spent a lot of time sitting down with community sports clubs and talking through some of the issues that community sport are facing, and working through, I guess, balance sheets and financial statements of community sports. So they've got a really good understanding of, especially some of the common issues that are seen at the moment and how to manage a community sports organisation. And with that, I'm going to pass over to Paul from More Australia.
Thank you, Jesse, and thank you everyone for joining this evening. I'll just start with a big congratulations for everyone still being on a committee of a community sporting club. It's been a really challenging 18, 20 months with COVID. Committee members are behind the scenes. We're the reason why community sport functions, and sometimes it goes the athletes get seen but the committee members don't, but we're behind the scenes making sure clubs function appropriately and we can run a community sports program. So congratulations everyone. It has been a tough 18 months, but hopefully next year we come out the other side of COVID and in a better space. By way of background, my name is Paul Robson. I'm one of the directors of More Australia. We mentioned More Australia. We're an accounting firm that specialises in providing some services to not-for-profit organisations, sporting clubs, and that community piece. We've got offices in Geelong and Melbourne, and Bo and myself actively involved with a number of not-for-profit and sporting organisations. I've got about 20 years experience in the accounting field, Bo around 8. I sit on a board for a state sporting organisation, being Surfing Victoria, so very familiar with some of the challenges our board riders clubs face, but also us as a sporting body in these current times with COVID. Today's session is titled Financial Management, but there's going to be a fair bit around financial literacy, because I think in order to manage an organisation, you really got to understand and have that level of financial literacy. We're going to be covering off on a number of topics. It's difficult when we present these items that there is going to be varying levels of experience and skills through committee members. So it's difficult to have one slide set to fit everyone's skill set. So reinforce Jesse's point, if there's any questions, please put them in the chat. We're here to talk those things through. And apologies if there are some things that are a bit basic to some of you. We've got to cover all bases for everyone. So we might kick off on the first slide. Bo's going to present through the first few slides, and then I'm going to come in and present around budgeting and some of the compliance obligations. So I'll hand over to you, Bo.
Great. Thanks, Paul. And good evening, everyone. Like Paul said, thank you for joining us. So I guess one of the first points we wanted to touch on was just some key areas of considerations for clubs. So some themes that we've been seeing that clubs have been focusing on through the current pandemic. So one of those areas is just around going concern of the club. And what we mean by that is, whether the club's going to have sufficient funds or the ability to meet its immediate debts in the future. And predominantly, that's a real issue for clubs that are facing, I guess, cash flow constraints. So, we've still got outlay of cash, but we don't have much cash coming in from sponsorships who are pulling their funds, from members who are not re-signing or, asking for deferrals or refunds from their memberships they've paid. So I guess one of the key focuses we wanted to touch on today was around that cash flow forecasting and reporting piece. Because that, I guess, will provide us with a bit of comfort around where we sit as a club in terms of our current cash and where we plan to sit in the future, and whether or not we'll meet our debts based on our current level of cash holdings. The other, I guess, key area is to monitor spend and building cash reserves. So that comes back to the first point about cash flow forecasting. So if we've got a cash flow forecast in place, which we'll go through some examples throughout this slide. If we've got that cash flow forecast in place, then what that means is we can effectively monitor what our future spend's looking like, and what impact that will have on our cash balance. So if the strategy for the committee is to build up a cash reserve, whether it might be to fund some capital expenditure in the future or just to meet its debts if we do face another lockdown, then we've got those tools in place to, I guess, see what impact our future cash will have on our current balance. And what that will do is effectively give committee members like yourselves the understanding or the tools to make the decisions that you need to make to alter the current course of the club. So if our strategy is to build our cash reserves, then if our forecast is showing that we're going to have a deficit in cash or a decline in cash in the future based on our spend, then that's where we can start pulling some levers to work out whether or not we can defer some avoidable costs or renegotiate some payment terms with suppliers. And what I mean by those is, having a look at what repairs and maintenance costs that might not be necessary for the club in the future, if we can put those on hold to maybe the following financial year once we're back to COVID normal, or negotiating payment terms with suppliers, so discussing with leagues or any key suppliers that we've got, whether we can just push out payment terms from 30 days to 60 days to 90 days, whatever they may be, to support the club's cash flows. And then another one might be around, so where we've got, we can't limit or reduce our expenditure for the club, then the other options might be around diversifying revenue streams and engaging with suppliers to or sponsors to either increase our sponsorship income, or I guess getting creative with current sponsors and seeing what additional value they can get from their investment from the club and potentially look to invest more. Now, a lot of these topics we cover off in quite a bit of detail in our next session around financial sustainability. So we'll be going and doing a deep dive into, what it means to defer cost and some strategies around that, negotiating payment terms and diversifying revenue streams, and creative ways to engage with sponsors. We'll go into those in detail. For the purpose of today's session, we wanted to focus specifically on the financial literacy and fundamentals of the club's financials, and then that cash flow reporting and budgeting piece as well, and what tools we can put in place now to assist us in the future for monitoring the club's financial health. So some key areas that we'll be focusing on as part of that financial literacy piece is around the profit and loss, balance sheet, and statement of cash flows. Now, we'll chat a little bit later just around the compliance obligations around preparing these statements, particularly at year end. But for the purpose of internal management reporting, I think it's good to have an understanding, because you can see how each of those statements flow into one another and how it assists in telling the story of the organisation when you're reviewing the financials. So at the moment, is there any clubs that have recently adopted their financial statements for the end of the current financial year or are about to? So generally, you'll have to resolve as a committee that the financial statements are true and fair.
Yeah, we're about to hand over our financials to the auditors for our end of financial year is end of September.
Oh, great. So you get externally audited. So that's an external audit, not review?
Yeah, it's a pretty basic one. Only it's still a lot of money for us, but it costs us about $2,500 to get a local accounting firm to do it for us. But we do get it externally reviewed. Yeah.
And based on your understanding of your committee, how comfortable are you around signing off that, I guess, or resolving that the financial statements are true and fair? Like, do you have a reasonable understanding of those financials to make that resolution?
I feel comfortable with that for a couple of reasons. One, I feel reasonably confident and comfortable myself with financial. I'm not an accountant, but with financial statements, cash flows, balance sheets, etc. And whenever we can, and at the moment we certainly have this in place, we try and make sure that our treasurer has some sort of qualification. I mean, it's not always possible. It depends on what volunteers you've got available, but generally speaking, we managed to find a member who's willing to do that role, who is an accountant, has that actual skill as well, which I think does means everything is probably a little bit more professional. But I know not all clubs have that opportunity.
Yeah. Yeah, absolutely, and that's a key theme we've seen across a number of clubs as we've been doing these strategic planning sessions with clubs. And some strategies around that is just, I guess, looking at the club's data and how they're collecting data on members. So, and that's particularly around occupations and skill sets. So then you can, I guess, where you do have a vacancy on a committee, so such as a treasurer role, if you do want to target those committee members that do have those qualifications, then you've got the data there to go and target them. Now, obviously, that there's a bit of an issue with the Constitution, making sure you're allowed to target those or target committees members for the committee role. But generally what we see with the Constitution is there is a carve out if there is that availability on the committee prior to an AGM, you can go and approach those people. But that's good to hear because I guess, one of the purposes of, and it's probably timely that we are doing this session because a number of clubs will be in the process of either getting audited or having their financials prepared for lodgement. So I think it's a timely session just to go through some of those key fundamentals with accounting concepts, which we'll discuss at a very basic level, but it should give you that a little bit additional comfort when you are signing off on that resolution.
I was going to just add.
Sorry, go on. Sorry. I was just going to say, I certainly noticed one thing I'd like to do on our committee is increase the financial literacy of other members of our executive committee. That's what we call our board, because I think many of them don't look closely enough at some of the financial reports that are created on a regular basis. And, I think that's really challenging. How do you upskill people in that area? But I spoke over someone else as well, so I'll let them go.
No, that was okay. And I was only going to just add on, obviously, with context as well, and Bo might touch on it, but the annual general meetings, that typically financial statements are kind of prepared in line with timing around annual general meetings. So even if you aren't directly involved in, I guess, that the preparing of financial statements, having that understanding heading into an annual general meeting when you are going to be questioned by your members potentially is really important as well.
Yeah, and just to support the comment there regarding the financial literacy of the board or the committee, as an accountant, one of the challenges we have when we sit on these meetings is the financial statements are tabled and everybody looks to the person with some type of financial literacy and says, are they okay? And you've come off a governance session previous to this. At the end of the day, every committee member needs to be comfortable in their own mind, not somebody else's mind, on are these appropriate, have they been prepared correctly? So today's session, and Bo's going to talk through the profit and loss balance sheet, the statement of cash flow. They're the minimum sort of financial statements we should see. Today is really around what is that minimum sort of level of knowledge people should have sitting on a committee around how to read and understand financial statements. So it is a very challenging one, and it is something that we see very common in the community sporting space. You may only have one or two people that have some level of financial literacy when we're adopting the financial statements.
Yeah, and I think just to add to that point, once you do have the basic level understanding of the financial statements, then that's when you can start also looking at your internal reporting function as well. And, you might be looking at the profit and loss on a monthly or quarterly basis. You may not currently be looking at the balance sheet or cash flow statements or anything like that. But when we take you through these reports, I think you'll start to get an understanding as to the importance of each of these reports. And just, I guess, some of the questions or concerns they can raise as you are reviewing them and the things to look out for when you are reviewing them. So we'll just jump straight into it. And after each one of these, I'll stop and pause. If there's any questions, do please feel free to turn your microphones on or jump in the chat function, and we'll try and answer all your queries. So the profit and loss or income statement that you can see on your screen there, we've got a bit of an example. What this statement is showing is effectively how the club has performed in a period. Now, this is an extract of Consumer Affairs' example financial statements. So they've got these available on their website in Word version. Now, generally what this statement will tell us is how the club has performed financially throughout the period. So what revenue or income we've derived during the period, and then what expenses or outflows we've incurred. And generally what that will get us is an end figure of either a surplus or deficit for the year. Now, if your club operates predominantly on a cash basis, generally what that surplus or deficit figure would give you is effectively what increase or decrease in cash you've had for the period. And we can see how that will work when we come to the cash flow forecasting piece and how we set budgets. Because effectively, if we set a budget based on a cash profit and loss, it'll generally give us a good indication as to where we'll sit with cash. So when considering the profit and loss, it can be useful to review prior year information. So at least we've got a benchmark to assess our current year performance. So generally, when we're looking at this, if we've got membership income and membership income's gone down, but our membership numbers have gone up, generally that would be a point to query why that may be the case. And generally with COVID, we're seeing that is the case for some clubs because they're offering waivers or discounts on their fees just to try and keep membership numbers or even drive up membership numbers during the course of the pandemic. And it's also good to review, I guess, if we're using this profit and loss in a budget or in a reporting sense, generally it's always good to set a budget and then compare our actuals against budget as well, just so I guess the committee's got an understanding as to where we thought we'd sit in terms of our profit and loss or financial performance, and then where we're currently sitting to date. And again, that comes back to, I guess, those levers we can look to pull if we need to. So, for example, if our revenue's down significantly and we've got a lot of expenditure coming up in the future, then we know we need to start, driving sponsorship or looking for grants or some sort of additional revenue to get into the club. So, when reviewing the profit and loss performance of your club, frequent questions that do come up are whether or not our net profit is in line with our expectations. So if we're making a significant loss for the period, generally if we've set a budget, we want to make sure that we're either meeting budget or exceeding. So if we're making significant losses, we want to generally do a deep dive into the reasons as to why. So that's where if we're doing a budget versus actual analysis, we can look at costs or revenue and where the club hasn't performed to our expectation. If we're reviewing this profit and loss on a frequent basis, so quarterly, then we can start to see where we've got significant costs that might occur. So, for example, we might have significant repairs and maintenance or significant admin costs that have been incurred by the club. Now, they may be incurred within budget, but there might be instances where we identify expenses that have gone out the door that either haven't been approved by delegation or are quite significant and should have probably come to the committee in the first instance. So it can sort of drive those conversations around where the funds are going and making sure that the committees are staying on top of who has control over those funds. So on the right of that example, we've got a bit of a breakdown and some examples as to what revenue or income or sales are for large and medium clubs and small clubs. So we've got a bit of a variety on the session today. So we thought we'd cover off both your larger style of clubs and small clubs. So generally with larger clubs, if they've got pokie machines or anything like that, typically we'll see things like gaming revenue. They might have grant income as well. Merchandise sales, so if we're selling T-shirts or any sporting equipment or anything like that within the club, we'll see that income. And then any interest as well, so if the club's got term deposits or just cash held within an interest accruing account, then we'll see that income in the profit and loss also. For smaller clubs, typically we'll see canteen income, bar sales is a common one, sponsorship income, and then membership fees also as a key income item. For the expenses, typically your larger clubs may have salary and wages. So if we've got employees, we'll see those costs sitting in the profit and loss. Any coaching fees if we're paying the coach, merchandise costs. So we've sold the goods, but then obviously we've got that cost for the goods as well. And then any interest on borrowing. So if the club has gaming revenue, they might have a borrowing facility against the license for those gaming machines. So typically we'll see interest associated with that. For smaller clubs, we'll typically have repairs and maintenance. Cancel rates for the facilities is another one. Insurance premiums, as well as league affiliation fees also.
Bo, I just put in the chat for those that can't see it. Obviously, a good example of maybe some unexpected expenses that have come from the last period of time have been the expenses that have been directly related to COVID. So around kind of that cleaning and what that has looked like for club, that you still have to pay for that equipment to help manage that return to sport and those requirements around that. And obviously to help with income and try and balance out those costs, there were a number of grants that were around to help offset that as much as possible. But I just thought I'd throw out an example in terms of something that probably wasn't definitely wouldn't have been in budget for most clubs last year, but definitely came up through that period of time as well.
Yeah. No, excellent. Thanks, Jesse.
And Bo, it might just be worth just touching on that profit and loss statement too. There are items in there that are non-cash items. So Bo's going to talk about the balance linkages, the balance sheet and cash flow. But if certain clubs don't prepare this on a cash basis, there will be items in these profit and loss that aren't cash. They're an accounting expense or an accounting revenue, but it's not a cash one, revenue or expense. So that you get some differences between cash and what can be in your profit and loss. And Bo's going to touch on that in a moment. So the big one there to call out is depreciation. That's generally a non-cash item.
Yeah, thanks, Paul. I was going to point that one out as well, so that's
sorry.
good. No, I wasn't going to cover that off, but yeah, when you finished, I was looking at depreciation as you were saying that. So the next key balance sheet is so the next key statement to look at is the balance sheet. Now, a lot of clubs on an ongoing basis may not table a balance sheet with their committee. Generally, what we see is it's only the profit and loss that gets looked at because the club committee members want to see, what revenue we've got in from membership fees and what expenses we've incurred, and what's coming up, and then generally they'll discuss those costs that are coming up and approve them. The balance sheet is a good statement to table at a committee level as well, and we'll get into the cash flow after this. But if you're tabling a budget or a cash flow forecast, generally what we like to see is the balance sheet being tabled as well as the cash flow forecast, because what that does, it shows the cash balances of the club, and that cash balance should feed into our cash forecast. So then as a committee, we know what our starting point is. We know the file's reconciled, and then we can have a look at our cash flow forecast and see what the impact of that cash balance will be based on what our future forecasts are telling us. Now, what the balance sheet effectively does is it gives us a snapshot as to the financial health of the organisation. So it's a little bit different to the profit and loss. So the profit and loss is a snapshot of how we've operated or performed financially, whereas the balance sheet is effectively the financial health of the organisation. So the key things we look at when reviewing the balance sheet are current assets, whether we've got enough current assets to meet our current liabilities, because generally that's going to be, that's our big test for when we're testing going concern is, do we have enough current assets to meet our current liabilities? And typically for a small organisation, that's going to be predominantly just cash. And they may or may not recognise trade creditors or our supplier invoices on the balance sheet as a liability, but typically it will be cash that smaller clubs do record. And then other items that we'll generally record for a small organisation would be plant and equipment. So generally, if we have sporting goods, typically some smaller organisations will record those on the balance sheet as well.
So just quickly, I was just going to say, in terms of a going concern, I think most people will understand, but just as a really simple explanation of I guess what going concern means, because it's obviously pretty important for clubs.
Yeah. So going concern, typically when we assess going concern, it's over the next 12-month period. So are we going to have sufficient funds or sufficient income to meet our immediate debts? So if we've got supplier invoices stacking up, we've got 35,000 worth of supplier invoices, but we've only got 15,000 sitting in cash on our balance sheet. What does that mean for the club in the future? Can we pay those suppliers? Are we going to have capacity to pay those suppliers? Are the suppliers going to call on those debts? Generally, those are the questions that get raised around going concern, and generally that is a focus for clubs at the moment, is just that cash flow piece, particularly for those clubs that didn't have a great cash reserve coming into COVID. So that's why I guess we like to see reviews of the balance sheet, because typically we want to see that the clubs are putting all their costs. So if we haven't paid suppliers, generally we like to see them sitting on the balance sheet, so they're out in the open. We can see them, we can monitor them, and we can just compare them against, what our cash balances are or what income we're expecting to get in the future. So that's not to say if we don't have the cash now to pay those debts, we won't get them in the next few months. Our season might just be starting, and we're expecting some cash to come in the next 2 to 3 months. But without having a cash flow forecast in place, it's sort of hard to really get an understanding as to whether or not we will be around in the next 12 months, subject to negotiating payment terms with suppliers. So does that sort of cover that, Jesse?
Yeah, I think that's a good one. I think especially just off the back of COVID, I think probably community sports clubs have maybe seen that word around more so than they ever have before. So just for any that maybe don't understand, those community members that maybe haven't been across the financial statements enough or much, that might just give you a bit of understanding as to effectively what that means.
I think just a very simple way to look at it, going concern means you're solvent generally. Like the two terms you could generally link those two terms. So going concern, you're solvent. If you're not a going concern, you potentially are not solvent, and we need to think about liquidation.
Yeah, and I think it's probably a bigger focus for those clubs that are getting audited, because it's obviously a significant audit focus as well, and it's a big risk for audit. So that's probably something they're looking at, and they're calling on clubs more regularly now to produce, I guess, the support for the going concern. And generally, that is a budget that they prepare. So what our cash is now, what our future incomes will be, our cash inflows, and what our future cash outflows will be, and what impact that will have on cash. So when we are reviewing the balance sheet, I guess the review of the balance sheet can answer a number of questions or raise concerns. So typically what we like to look at is whether or not the club's reinvesting its retained earnings. So you might see the retained surplus we've got in the equity section there. That balance might be building up significantly, as well as our cash balance. And what that might generally tell us is that the club may not be, reinvesting its cash back into the club as much as what it probably could. And there could be reasons around that. It could be that the club's building its reserves either to support it through times like pandemics, or for those capital projects that it may have budgeted. So, we might be saving up $50,000 to contribute to a capital project, which is why that's not being reinvested. Other questions that it could raise is if members are paying their fees on time. So subject to, I guess, the financial capacity of the club. Typically, some clubs do record their membership fees owing on the balance sheet. So we'll see that as an asset. So similar to where we've got accounts receivable and other debtors sitting there, sometimes membership fees will form part of accounts receivable. So that will sort of give the committee another indication as to, are we putting enough efforts into the recovery of our membership fees? And again, the cash position of the club, if we're not recording that many assets, at the very least, we can get an indication as to what our cash balance is, how that compares to last year, and also how that compares to budget, and what the impact of our future cash flows will have on that balance.
But I was just going to quickly ask another question. It's probably another common term that comes up in managing a club is accounts payable, accounts receivable. I guess in simple terms, maybe just to help with a bit of an explanation on that as well.
Yeah. So accounts receivable. So typically, if the club's operating on a cash basis, we won't have these items recorded on our balance sheet. So we wouldn't have accounts receivable or accounts payable. The reason for that is because we only record the transaction once it's received in cash. So an accounts receivable, like the example I provided before, might be we've issued an invoice to one of our members to pay their membership fee. So we'll record that on the balance sheet as an asset, because effectively what that means is it's an economic benefit that the club's going to receive, and that's basically the definition of an asset. On the flip side of that, a trade creditor is just one of the club's suppliers that we have not yet paid. So if we're operating on a cash basis and we're paying our supplier invoices as they come in, then we won't record the balance on the balance sheet. But if we're not paying them, we're sticking to our trade terms. So if we've got 30-day trade terms with most of our suppliers, that balance should build up on a monthly basis. By the end of the month, we're likely going to have a big trade creditor balance. And then when we make the payment to the creditor, we would then wipe out that balance. So that's the distinction there between the two. And I guess some of those, I guess, other terms that we're using in terms of assets and liabilities. So there's different components of assets. So we've got current assets and we've got non-current assets. So there are notes in the slide there, but I'll touch on those as well. So assets of the club. So where we've got current assets, generally we expect to derive the benefit of that asset within a period of 12 months. And common ones there are cash or membership fees. So generally we expect the members to pay within that year. So that would be a benefit that we would derive within 12 months. Whereas non-current assets, typically benefits we'll get from assets, but it will be over a longer period than 12 months. So, and the good one there is equipment, or if your club owns buildings or the leasehold improvements and council doesn't own them, then we would record those assets on the balance sheet as a non-current asset. And effectively what happens there is we record them as an asset, and you might write them down over their useful life, which could be, subject to the asset, anywhere between 3 to 20 years if it's a building. And that was the depreciation point that Paul was making earlier. So the depreciation is a non-cash item. It's just the realization of an asset that we've recognised on our balance sheet.
Do you want to vote? Just again quickly, depreciation, whether some have kind of benefits of that or not. Just in really simple terms, I guess, why, from an accounting perspective, you'd look to depreciate what might be a non-current asset, Bo or Paul?
Yeah, can I maybe just use one that's probably a common one we might see in clubs is the leasehold improvements. So if we have, either a peppercorn lease or potentially a lease that might go for 5 years, and we fit out or do something to those premises with our own cash, that is an asset. So we've got this lease fit out cost. We've done something to the club rooms. And in 5 years, we've got to either renew that lease or basically walk away. So we might assess that those fit out, it's wrong to expense that all day one because it's going to give us benefit over 5 years. So what we're trying to do through depreciation is say we've got an asset, we've spent $100,000 on a fit out. We think that's going to last us 5 years. So we think then 5 years, $20,000 a year, we've got to consume that asset and take that $100,000 and $20,000 a year goes into the profit and loss as depreciation as we reduce the value of that asset over its life. So depreciation is an accounting term for just consuming that asset over a longer period of time as opposed to just expensing it in the profit and loss day one.
Yeah, it's a great example. Thanks, Paul. Now, the other side, so that covers off assets. So then the other side of the balance sheet is our liabilities. Now, liability is effectively an obligation to make future payment. And typically it's to a supplier or it could be a financial institution. So again, liabilities have current and non-current elements. So typically where we've got a current liability, we're obligated to meet those payment obligations within a 12-month period. So typically that's going to be your day-to-day suppliers. We'll have to meet those within 30 days. So we recognise those as a current liability. On the other hand, we've got non-current liabilities as well. So that's, again, where we're not obligated to meet those requirements within 12 months. Then we can record it as a non-current liability. And typically what we'll see with clubs is it could be borrowing facilities. So again, where we've got gaming licenses and where we've borrowed against those licenses, then we might have a non-current portion of that borrowing facility. Employee entitlements is another one as well. So where we're not required to pay long service leave entitlements out immediately, we can record them as a non-current liability also. And then the final section of the balance sheet is equity. And now equity is effectively an indication as to how the club's performed historically and how much surplus we've accrued based on past performance of the club. So when we're having a look at the profit and loss in the previous slide, we had at the bottom of the profit and loss net surplus or deficit. Effectively, if we've got retained surplus in the balance sheet, what that means is we've accrued a net surplus in historical periods and in the current period as well, and that's what forms equity. And equity is effectively what funds or what retained earnings we've got within the club to spend on future investment in the club. On the flip side of that, if we were to have a retained deficit, it means the club's made historical losses, and effectively we've got no additional outlay or future investment for the club. So typically, where we've got retained surplus building up with clubs, we'll generally see cash being one of the key items that we see also increasing. So if we had retained surplus of 50,000, generally cash balances would be up there as well, unless the clubs reinvested those funds into some of the capital components of the club. So if we haven't got a large cash balance, but we've got large retained surplus, that could be because we've invested those funds into equipment for the club or, enhancing the club's facilities.
And just to that point, equity is a simple function of positive surplus means you've got more assets than liabilities, which is a good space to be. Or a deficit means you've got more liabilities than you do have assets. So when we talk about equity, you could also think of it as if you've got a positive balance there, you've got more assets than you do liabilities. And that's a good spot to be, and that's where we all want businesses to be, any organisation. And the balance sheet is that fundamental statement that any accountant or anyone, I think, with a finance background will look at first to understand the health of the organisation, because the immediate question we're asking ourselves is, can this organisation fund its current obligations? And that would be a yes, where we have assets higher than our liabilities.
And I suppose further to some of the points you made, Bo and Paul, I think that's, I guess, the benefit when you do have the balance sheet on top of the profit and loss statement. Profit and loss, you might see a really healthy financial year, but if it's in the context of a poor previous 5 years, you don't really get that full picture of kind of where the club's sitting. Whereas at least the balance sheet and a profit and loss statement, you kind of get the short-term performance within the context of the longer-term performance too.
Yeah, and I'd suggest to everyone as a takeaway today, there's one thing to take away from financial management of an organisation, is to make sure you've got an up-to-date balance sheet that's presented to the committee, because that's telling you your assets and liabilities and your health of the club. Profit and losses can fluctuate, but the balance sheet's a critical statement.
And with a lot of these statements we are discussing tonight, a lot of, I guess, accounting packages that are out there cater for these. So if your club's using anything like Xero or QuickBooks Online, generally you've got integration of your bank account into that software, and then the software has all the reporting packages built within. So these can just be ran off at a click of a button. So if you're concerned that, I guess, volunteer time is hard to get anyway, and then you're adding all this additional requirements, if you are using one of those packages, generally it's not too complicated to run these off. Once the template's set up, it's a pretty straightforward process.
I think that's a really good point, because it's something that's come, especially the strategic plans that you've been working with a lot of the community clubs, is that's one of the kind of first recommendations is to, if you've got some funds, I don't know, COVID's presented huge issues around that space. If you've got some funds, that can be a really good first step, is just to invest it in some of those packages, because I don't think they're too expensive, but they can give you that huge benefit in terms of reducing volunteer time and giving you a bit more confidence in that space.
Yeah, and that's been the feedback we've had from clubs when they've adopted. So they've gone from doing the Excel spreadsheets using the bank statements to recreate the P&L or the balance sheet, to then going to Xero. Yeah, the treasurer or whoever's maintaining the records is finding that they're investing a lot less time, but getting better, I guess, results and outcomes from their time that they're putting in.
Hey,
and I know.
So I was going to say quickly, we've just had a question come through that you might be able to touch on within that balance sheet side of things. So Nikki's just asked, how often would you recommend the balance sheet is reviewed by the committee?
Generally, so like we were just touching on, if you are using QuickBooks or anything like that and you're running off the P&L report anyway, I would generally run it off as a package. So I'd have balance sheet and profit and loss ran off together, and you would table those both within the same pack. So yeah, typically we would have a committee pack and it would form profit and loss, balance sheet. And then if you've already got a cash flow forecast template, we would include that in there as well. So if you're meeting monthly, I would be tabling them on a monthly basis or quarterly, whatever the frequency of those committee meetings are. I think the balance sheet is just as important as reviewing the profit and loss.
Yeah, and I'd go to one step further and say I feel the balance sheet's the most important statement out of the cash flow, balance sheet, and profit and loss. And to that point around how often should it be reviewed, I'd say at least quarterly. At least quarterly.
And just a lot of the session that we obviously talked on Monday was around the governance side of things. I think from a governance perspective, it's always good to, as much as you can, if you can give committee members a bit of time to review the statements before the meeting. So if you can kind of get them prepared that couple of days so they've got some time to consider it, maybe bring up any questions they've got. So then you can at least, from a governance perspective and running effective meetings, you can kind of get through that stuff relatively quickly because at least you've had a chance to read through it rather than giving them the documents at the committee meeting itself and then spending 30, 45 minutes going through just because that's the first time they've had a chance to actually look at them.
Yeah.
Yeah, absolutely. And there is that financial literacy and upskilling piece as well. So if you do have an accountant or someone on your committee, there'll be a few sessions of education, taking them through what it all means. But then once, I guess, they've sort of got that understanding or the basic understanding, then that's where it will drive the conversations and the questions and help with decision making of the committee and setting the strategy going forward. So back on the slide, we've got, I guess, to the far right, again, some examples between large and small clubs. So we've got here examples for assets, current and non-current assets. So term deposits for large clubs, generally we'll see term deposits. Now these can be current or non-current, subject to the terms of the term deposit. So some term deposits can be at call, which means we've got readily access to those funds, so we can just pull them out when we like. So generally that will be a current asset. If the term deposit's invested for a period of over 12 months and we can't easily access it or we're penalised for accessing it, then typically you'll see that as a non-current asset on the balance sheet. For your larger or some medium-sized clubs, another one we'll see on the balance sheet as a non-current asset is gaming licenses. So that's an asset. We're paying for the gaming license, and it can be for a period of up to 10 years. So what they'll typically do is we'll recognise that gaming license as a non-current asset, and as we were talking about earlier with depreciation, we'll depreciate that over the life of the license. And then the other one we've got is trade receivables. So we spoke about that earlier. So membership fees was a good one with trade receivables or other receivables. If we've issued someone an invoice for their membership fee, typically we'll expect payment within 12 months. So that we'll record that as a current asset on the balance sheet. And another one there is prepaid expenses. So if we've paid a supplier in advance for a service, they're going to deliver it in the future. If they're going to deliver that, say, in the next 3 months or within the next 12-month period, we'll record that as a current asset as well. Typically for smaller clubs, some of the key assets we'll see is cash. So cash will be a current asset. Sporting equipment. So if we've bought, could be bats, footballs, or it could be stuff for the bar, anything like that, we might record as a non-current asset because we expect to get benefit of that asset over an extended period of time, greater than 12 months. Membership fees, if we are recording them on the balance sheet, so if we've got a system for recording them, so say we're invoicing out of zero, we'll typically record those as a current asset because we expect payment within 12 months. And alcohol or canteen supplies, so we're just talking about inventory. We generally expect to turn inventory over within a season, so typically those will be current assets as well. On the flip side, for liabilities, so again, current and non-current liabilities, accrued expenses, so where we've incurred a service, so say an electrician's come to the club and delivered a service, but they haven't invoiced us for it, what we can do is accrue that expense within a particular time period, on the anticipation that we'll get the invoice in the future. So we take that expense up in a particular period, and then that will record the liability. So it's similar to a trade creditor, but effectively we just haven't received the invoices yet. And then the next one is trade creditors. So that's the suppliers issued us the invoice and we just record that on the balance sheet as a current liability. Borrowings, so this is the larger style clubs. Typically, borrowings will be recorded as a non-current liability, but there may be an element of borrowings that is also current. So that's typically where we have to make repayments within 12 months. So similar to your mortgage repayments, you'll make a set number of mortgage repayments in a 12-month period. That portion of the borrowing facility is generally current, and then the remainder sits as non-current because we'll make those payments after 12 months.
A good example of that, I suppose, there might be some clubs out there. Obviously, a lot of facilities are council owned, but there are some clubs that have their own facilities. And if they don't have the funds to potentially support that, the purchase or the building of those facilities themselves, that they might borrow some funds that then obviously have to sit somewhere in terms of paying back those funds over time.
Yep. And then the other example was employee entitlements. So this is long service leave that employees take. So typically when someone's reached 7 years of continuous service, they'll be entitled to those leave entitlements. So once they're entitled, the club's effectively obligated to make payment if the employee was to take the leave or to be terminated from the club as an employee. So because they've met that vesting period, it's called, or we're obligated to make payment, we record that as a current liability. But if the employee hasn't reached the 7-year vesting period, then we treat it as a non-current liability because we're not expected to pay it out within the next 12 months.
And one of the other ones that sometimes we may see at club level is where there's some type of, I'll use the word grant, but it's probably the wrong term from a technical accounting perspective, but where you're being granted some funds to deliver a program and there's some contingencies so there's some obligations to that grant. And if you do not fulfill those obligations, you have to hand the grant back. So the example might be you need to put 100 kids through a program, some type of sporting program. And once you do that, you don't have to hand the grant back. So you might get to a point where you've only done 30. You've got to understand whether you actually can book that grant as your money, or do you need to have it parked on the balance sheet here as a liability that you might have to give some of it or all of it back at some point too. So grants can get a little bit technical, but they're ones just to watch out for, that they may actually be a liability. They've given you the money, but you may have to give it back at some point.
Yeah, that's a good example. And then for smaller clubs, typically what we'll see is supplier payments. So if we're recording our unpaid supplier invoices as a creditor, we'll see that as a current liability. And GST payable might be another one as well. So if we've registered for GST and we owe money to the ATO, typically we'll have to pay that within the 12-month period.
And is everyone aware of the GST threshold for clubs when you have to be registered for GST? If not, $150,000 turnover.
Yep. Thanks, Paul. I might just stop and pause there. If there was any questions, Jesse, in the chat function, or if anyone wants to flick their mic on and ask any questions just on the balance sheet or even the profit and loss, if anything's come to mind.
Yeah, it's Scott Taylor from South Oakley Bowling Club. Can you just expand a bit more on that GST requirement being $150,000? So if we trade under $150,000, what does it actually mean? Yeah,
so the threshold under the legislation is if you're over 150, you're mandatory. So effectively, a not-for-profit entity is 150. Anyone that's a for-profit entity is 75. So assuming you're a not-for-profit entity, you're at $150,000 threshold. If you're over that threshold, you must be registered for GST. What that means is any taxable supply, so anything that you are supplying to your members or a customer, you're getting revenue for, you must charge GST, and you get the benefit then of claiming any GST on any payments you make that have a tax invoice. So Bo mentioned, you might have an electrician come in and do something. They issue you an invoice. There's GST on top of that invoice. You get that GST credit back. So that's mandatory at the $150,000 threshold for turnover or your revenue number. If you don't hit that threshold, it's not mandatory, and you can elect to be registered for GST. So if you decide not to be registered, it means you don't have to remit any GST to the tax office, but you can't claim any of the GST credits on invoices. So, for example, the electrician, if you're below the threshold and not registered for GST, they might have issued you an invoice for $1,000 plus GST, so $1,100. You have to pay the full $1,100, and you can't claim that $100 back from the tax authority, ATO. Does that make sense?
Yeah, it does. No, thanks for the clarification. Yeah, I mean, we use Xero, and that obviously helps make a lot of those decisions for you as you put things in and receipt stuff. So yeah, but that helps. Thank you.
Yeah, and I'd suggest again, if you're over that threshold, I would strongly advise that you have some type of accounting system in place to manage your GST obligations.
Yep.
Trying to do it on an Excel spreadsheet is just fraught with danger.
Yeah, and I guess the other point there is a common theme we've seen with a few clubs that we've picked up on just through reviewing financials as part of the strategic sessions we've been doing with leisure networks. Some clubs will typically net off some of their costs in the profit and loss. So, for example, we might see some clubs, they've got merchandise that they'll sell. So we'll see them recording the income, but then in the same account, they might also put the costs. So sometimes they might not be charging a margin or markup on those services that they're providing. So they basically just want to net them off in the profit and loss. If you're assessing for GST, you really need to split those two components out. So the GST would be on the income side of the transaction. So if we're doing any netting, we need to effectively pull those expenses out and assess on the income side. So we had a couple of instances where we actually flagged with a few clubs that they may be over the GST threshold just by how they were accounting, whereas what they were actually reporting as profit and loss was a lot different to how we would assess for GST. Well, the final statement I just wanted to touch on was the statement of cash flows. Now, typically, smaller clubs won't prepare a statement of cash flows, even for their annual compliance. Now, we'll touch on what the, consumer affairs requirements are for preparing financial statements, but statement of cash flows is listed as one of them, but it's not typically one we see prepared often. And it is one of the statements that is provided in consumer affairs example financial statements. Now, generally, statement of cash flows is a challenging statement to actually prepare if you don't have software like Xero or QuickBooks. So Xero or QuickBooks, if the system's set up right, it will drop out this report for you with the click of a button. If you have to prepare it off an Excel spreadsheet, typically you'll need an accountant or someone with a high degree of accountancy or financial literacy to prepare this report. But I guess why I wanted to table it is because it can actually be a valuable report to review as a committee on an ongoing basis. So the statement of cash flows is predominantly prepared only for financial statements, but Xero does allow, and QuickBooks, for this to be reported on a more frequent basis, so quarterly, monthly, however you require it. So the statement of cash flows, it's segregated into three components. So you can see in the bold in the example, we've got cash flows from operating activities, cash flow from investing activities, and cash flow from financing activities. And what the objective of this report is to effectively do is to summarize how the club has spent its funds throughout the year, and basically gives a reconciliation at the bottom to say, what was our cash at the start of the year? What's our cash at the end of the year? And what was the net increase or decrease as a result of our operating activities, investing activities, and financing activities? So for a club, if you're reviewing this on an ongoing basis, so quarterly or monthly, whatever your committee meetings are, generally this will give you a snapshot as to what funds we've spent during a period. So if we're meeting on a quarterly basis and we're at the end of September, we're reviewing September quarter, we can see how much we've received from our members versus how much we've paid to suppliers, employees, or any taxation obligations like GST or anything like that. Typically, that will show up in this report. So what each of these sections mean, so for operating activities, that section effectively tells us how the organisation's either received cash or spent cash on a day-to-day basis for the club. So really focuses on day-to-day operations and on how we're spending money. Investing activities, that focuses more on the capital elements of the club. So how much have we spent on, say, capital purchases, so leasehold, if we're doing some sort of development on the building, how much have we spent on the building development? How much have we purchased for equipment during the period? Typically, those items will come up in the investing activities. Now, that's in contrast to repairs and maintenance. So repairs and maintenance, because that is, I guess, a cost that we're not saying has a future economic benefit for more than 12 months. Typically, a repair type cost will get expensed. So we'll see that more in the operating activities as opposed to investing activities. So investing activities is really anything we're going to recognise as a non-current asset on the balance sheet. So really just plant and equipment type costs. Or if we sell some equipment, typically we'll see that as an investing activity cash inflow in the period. Financing activities. Now, financing activities may not typically be applicable for smaller organisations. So it's really only for those large organisations where we've got borrowing facilities. So if we've borrowed for a gaming licence or we've borrowed against a development of the club facilities, that's where we'll see proceeds from our borrowing. So when we get the borrowings come in, we'll see that as a cash inflow item on the statement of cash flows. And where we make repayments of borrowings, that will be a cash outflow in that statement. And then, as I mentioned earlier, at the bottom, we'll have what our net cash position was as a result of those activities and what our opening cash was and what our closing cash is. So this statement here, when we look at this, typically our cash at the end of the financial year, that balance there should align to what we've got recorded on our balance sheet as cash as well. So you can go back and do that check. So if you want to check off that all the statements reconcile, typically we'll start with the balance sheet and then we'll go into the cash flow statement, check that our closing balance equals our cash, and then you know you've got, I guess, a true reflection of what our cash movements were through the period. So I guess as some examples. So again, off to the right, we've got some examples of each of these different cash activities. So for operating activities, large to medium clubs may have gaming income they've received during the period. There could be grant income as well as cash we've received from merchandise sales. Now, in the red, we've got the cash outflows. So typically for a larger club, if they've got gaming facilities, they've probably got bar staff and employees. So payments to employees we would see as an operating cash outflow. For smaller clubs, generally operating activities would include canteen income, bar sales, so any cash we've got from those areas of the club, and cash from members as well. And then their outflows may be payment to suppliers alone. Investing activities, so larger to medium clubs, they could have the sale of equipment, so that would be a cash inflow. So if we've got some old rollers for a cricket pitch or anything like that, and we've sold those for $1,000, typically we'll see that as a $1,000 cash inflow during the period. Any cash outflow, so if the club had surplus funds and they've gone and invested that into a long-term deposit, so we're not recording that as a current asset, then that would be reflected as a cash outflow because we're saying whilst it's still cash, it's not cash that's readily accessible. So because we may have penalties or anything like that that deters us from pulling those funds out when we need them, then we don't record that as cash anymore. So then we treat that as a cash outflow and it's recorded separately. Another cash outflow is typically building improvements, but again, any sort of equipment or long-term asset purchase we'll see as an investing activity cash outflow. For smaller clubs, purchase of equipment is a common cash outflow that we see. And the final one there, so typically this is just for your larger or medium style clubs, but typically we'll see the receipt of borrowings and repayment of borrowings in the financing activities.
Just on the cash flow statement, this is probably the forgotten statement that gets missed in a lot of financial statements. This is probably when I look at a set of financials, I look at the balance sheet, the cash flow, then I'll look at the profit and loss. And when I look at the cash flow, the primary thing I'm focused on here, and I think is important as a committee, this is where you want to get your finger on the pulse on reading these pieces of information, is the cash from operating activities. That basically is saying, is the organisation generating cash from its operations? Positive cash flow, good. Fantastic. But if we're operating at a loss and we're churning through cash, we've got to fund that somehow, and that's not a good sign. So the cash flow from operating activities is a really important one to monitor. And then that will tell us how are we buying assets, which is investment, or are we using our operating cash, or are we going to have to go and finance that from somebody, and that's your financing activity. So important financial statement for the committee members to understand and review. I'd say at least annually. It'd be better to review this quarterly when you review your balance sheet as well. And as Bo alluded to, your accounting systems, your Xeros and QuickBooks and the like, can produce these if they're set up properly. So we wanted to spend a lot of time on the three financial statements, being the profit and loss, the balance sheet and cash flow, because fundamentally they're the tool of trade for any accountant will look at to understand the health of an organisation. So it's very important that as committee members you're familiar with those statements, what they mean and what they tell you. The next piece we're going to touch on is the budgeting process, and effectively what the budget is forward-looking projection of those financial statements. So to date we've spoken about preparation of the financial statements and what they are. Generally, we're looking in the mirror to say, well, what happened in your profit and loss for a 12-month period? What at a point in time does our balance sheet look like? And our cash flow statement, what happened over a 12-month period? We're looking in the mirror. And that's great. It gives a snapshot to the committee of the financial health of the organisation, where it sits in its current state. But budgeting goes to that next level around, well, how do we set a strategy or plan what we want our financial statements to look like in the future? So generally a budget is simply forward-looking set of financial statements. And when we set up a budget, there's a couple of fundamentals we need to consider as we go through and prepare a forward-looking set of financial statements. The first one is what period we're thinking about forecasting. Are we thinking monthly, quarterly, annually? What's that period we want to set a forecast for? And there's no right or wrong answer, but most organisations would look to do a 12-month period as a minimum. And if you want to align your budget to your reporting, so if you're meeting as a committee, say quarterly, potentially you might set a 12-month budget, but it's broken into 4 quarters, so you can report quarterly against budget. The second thing to consider is what financial statements will you budget going forward? Now, the most common one, and I'd say any organisation I'd be involved with, I'd say it's mandatory to do, even though it's not under legislation, is your profit and loss. You want to understand at least, are you going to generate a surplus for the year, and how do you monitor your spend in your profit and loss? So when you set your profit and loss, you've got that concept of, do you do it on a cash basis or what we call an accruals basis? An accruals basis will be when you may have some non-cash items in that profit and loss, things like depreciation we've spoken about, but it's more so when you generate the revenue. So if we send out membership invoices all in 1 month, but we won't be paid those, might be a 90-day lag till we collect them all. Under the accruals basis, we're making the assumption that we're going to recognise all that revenue in month 1. But if we're on a cash basis, we'll recognise as it drip feeds in. So you've got to understand when you're setting a budget, are you doing it on a cash or accruals basis? And then those fundamental assumptions in the budget. So we've got to think through, how do we build up our revenue stream? So if we're thinking about membership base, you might put some sophistication on how you budget that. Number of members or type of members, how much we charge them for their membership. These are important elements that you build up. So you've got a set of assumptions that you go, as we set this plan for a budget, we've got a set of assumptions on how we think we will trade for the next 12 months. And then as you report against your budget, you can make an assessment where things deviate from budget. So if you've done some sophistication in terms of how you assess revenue, it is important to then go and dissect that where it deviates, your actual results deviate from your budget.
I think, Paul, just a really quick one, again, mindful of time, but a really good, when you mentioned levers at the start that you can pull, a really good one. And I think we saw it with sport during COVID, was the benefit of having a budget is obviously seeing what you expect your financial position to be. And then you can start potentially tweaking with different categories to say, okay, well, if we increase our membership fee by a figure, maybe $5 or $10, whatever that might look like per member, to a figure that's not going to be a huge significant impact to them, but for you at your financial position, it might be that difference between kind of being in the red to the green. The benefit of a budget, you can start to see where those little tweaks can have benefit, I suppose.
Yeah, and to go that step further, what a budget can do, if you build in those assumptions, you may be able to change the assumptions and do some what-if analysis to say, well, what if we did put up our membership fees by 5%? What's it do to our bottom line? Or what if we do control some payments to suppliers, or match day payments aren't going to be there because of COVID? What does that do? That scenario analysis to understand what that means for the club, and the budget's a really good tool to allow that what-if analysis. One thing to bear in mind when you prepare a budget, and most organisations will do that profit and loss budget, the thing missing from your profit and loss is your capital expenditure. And the most common one you'll see at club level will be purchase of equipment, or potentially some fit out for leasehold improvements, or you might even buy a premise. They're assets you're buying, and your profit and loss doesn't represent those assets. So if your club does make those additional significant investments in assets, you may need to then consider, you might have a profit and loss budget, but you may need to start to do a capital budget of what are those assets, what cash do we need to buy assets as well as fund our expenses. So capital expenditure budgets are also an important element to just think through when you're preparing a budget. And the other thing when you're preparing a budget is you've got to align it to the strategic plan of the club. So, if the strategic plan's set to say we want to change our membership classes, we want to move from one type of membership to a tiered membership structure, high, medium, low, and we think this is going to grow our engagement with more members and grow our membership base. If that's the strategy for the club, then you want to make sure your budget considers that, and we don't go back to, what was the revenue last year, and we'll just use that number. You've got to make sure you align your strategic thinking with your budget.
I'll just quickly note, I noted in the chat, we will be obviously providing the slides with the recording. So in terms of some templates, you'll be able to see that. You'll be able to pick that up in the slides that we share as well.
Yeah. So the slide here is a very simple budget, very simple. And I'd say at a bare minimum, this is what clubs should have. No matter what size you are, you need a very simple budget. As you become a bigger club, there's probably a need to consider budgeting, cash flow, balance sheet, and profit and loss. But what we've got in front of us here is just a simple profit and loss budget. And a couple of things you can see here is the timing of some of the revenue. Membership fees that come in February every year. February and June every year. You can see in here that we're forecasting our assumptions in July, some night games. So we expect to have increase in bar sales in July. Yeah, so some of these things might align to then the strategic thinking or the plan for the organisation, and make sure then your budget aligns to what your intentions are. Just mindful of time, I won't go through all of those items, but the key thing here is make sure you document your assumptions. So whoever's preparing the budget, the committee members, before they approve the budget, need to understand, well, what are those key assumptions in the budget, and are they realistic? Are they achievable? Are they going to be a long stretch, or are they just wrong and we need to go back and redo the budget? And remember, your budget is a fundamental governance tool. It's basically a plan that the committee will approve to allow people to then go and achieve the objectives of the organisation. So I was just
to say, Paul, just on that as well, in terms of, do you want to maybe just really quickly touch on, I guess, when there is that delegation within a committee role? So if it's to a subcommittee or a key volunteer, how the budget can help with that side of things?
Yep. So what we see there is some layers of delegation or control on who can make decisions in an organisation. And some of those decision-making powers will be financial delegations. So an individual might be able to spend up to X amount of dollars as long as it's budgeted for. And if it's not budgeted for, we've got to go back to the full committee to get approval to spend outside of what we're budgeted. So that also acts as a really good control to monitor spend, but prevent somebody spending outside of their delegated authority, and all of a sudden you're sitting in a committee meeting and you go, whoa, we blew a whole heap of money on something. What happened? Why? It's after the fact. Whereas if you have a clear budget and people understand their delegated limits, they would have to come back to the committee to get approval to spend that extra money. Okay. The next slide, so once you've set a budget, the next slide's just demonstrating how you might monitor budget to actual. So think through here, we've gone through our suite of financial statements. What we're looking at the moment is the profit and loss statement. And you'll see there's a couple of columns in here. We've got one titled actual and one titled budget, and that's for a quarterly period. And then we've also got some reporting on actual for the current year versus last year as well, just to get a bit of a benchmark on how we're tracking on historical performance, but also budgeted performance. And this type of reporting to the board or to the committee is really critical, because it's demonstrating the committee, are we on track to achieve our budget or not? And how are we going against last year? And where we get variances, and you'll see there's some red crosses in there, the question is, if I look at this, bar sales are down $60,000. We want to understand why. Is it we had to cancel some functions, so we just didn't have the bar sales? And if that's the case, we should see our purchases also come down. Or is it that we may have an issue around some of our controls? We've actually generated the sales, but they're not getting banked in our bank account. So understanding these variances become a really important control tool for the committee. You're seeing here we have actual sponsorship of $84,000 that we didn't budget. Fantastic, we've got that. So how are we going to use that? What are we going to use that for? If we haven't budgeted for that, what do we need to do? Do we need to go and have a conversation around how we spend that money, or does it go into our reserve? So understanding your variances between budget and actual is a really important element for the committee to discuss when they meet. And the historical, so prior year to current year, is another good benchmark just to understand how the organisation is tracking against historical performance. The next slide, so I'll just finish up on budgets there and we'll move on to the compliance obligations. So compliance obligations, not a sexy topic. People really, it's not something that a lot of committees may want to get into the detail. But the problem here is this is the stuff that's legislation. This is mandatory requirement. And if you don't follow this as a committee, you're breaching legislative requirements. So basically, you're not complying with the law. So I understand the attendees today represent incorporated associations. So we've got a whole suite of different entity types in Australia, primarily local sporting clubs, community sporting clubs will be an incorporated association. So what that means is under Victorian law, we have an act that allows a group of people to come together and incorporate as an association. So that gives some limited protection then for the committees, because if you're an unincorporated association, it's like a partnership and everyone can be sort of liable for each other. This gives you some further limited protection, but it also means that the club can enter into contracts as a club. So I understand everyone's an incorporated association. When we look at incorporation associations from an accounting perspective, the questions we ask is, what tier are you? Are you tier 1, 2, and 3? And this is an important piece everyone needs to understand. Tier 1 is a small club. And currently, that means your turnover is less than $250,000. If you're a tier 1 organisation, you don't have a huge amount of financial requirements to consider regarding audits and reviews. What it means is you need to prepare your financial statements, and the committee will need to give a view on whether they're true and fair. So there's no other party really looking at those financial statements to give that view. So compliance levels for tier 1, it's a low cost option. The next level is then a tier 2 organisation. A tier 2 organisation is where your revenue is between $250,000 and $1 million. And that means you must have a review done. And I'll touch on what a review is in a moment. And then tier 3 is where you turn over more than $1 million. And that means you must have an audit done in accordance with the Australian auditing standards. And I'll touch on what that means. But before we talk about the audit and review requirements, the other fundamental point to think through if you're a tier 2 or 3 is Consumer Affairs talk about the Statement of Accounting Concept 1. Now, I won't get too technical here, but accountants have a huge rule book of accounting standards. And one of the fundamentals to that rule book is this Statement of Accounting Concept. And what Statement of Accounting Concept 1's alluding to is to say, if you have people that rely on your financial statements and that's the only piece of information they've got to make financial decisions of your club, you are a general purpose, you need to prepare general purpose financial statements. And general purpose financial statements mean you need to adopt all the measurement and recognition criteria of accounting standards. So anyone that would be a tier 3, turnover more than $1 million, I think it's highly likely that you may actually need to prepare general purpose financial statements, or you want to have a very robust conversation about why you wouldn't be preparing general purpose financial statements. That means applying the accounting standards. There is a carve out in the accounting standards that says if you are in that space, you can adopt what's called the reduced disclosure regime. That means we need to do our numbers in accordance with accounting standards, but we don't need all the disclosures that you might see in a listed public company. You know, look at BHP's financials, they're probably 100 and something pages long. You don't need all those disclosures, but your numbers still need to be the same. So all committees should have that conversation around what is the accounting framework they're preparing their financial statements under, and are we at risk that we need to prepare general purpose financial statements? So the next element then is an audit versus a review. So an audit is where somebody provides an opinion, being an auditor, that your financial statements are materially correct. In the accounting industry, we call that positive assurance. It's basically somebody saying, I believe these financial statements are materially correct. And they're putting their opinion out there. That is significant, and because somebody is saying that else is saying independently from the committee, these are materially correct. Now, the word materially is important because they could have immaterial error in there. Material means nothing of significance that would impact the reader or a user of those financial statements. What an audit isn't designed to do, which I think is something that is not necessarily always understood, it's not designed. A financial statement audit is not designed to detect fraud. It's not designed for that. If you had suspect some fraudulent activity, you need to talk to an auditor about some specific procedures to be done on detecting fraud. A financial statement audit is to express an opinion that the financial statements are materially correct. If you don't go through the audit phase and you go through a review, that's what we call negative assurance. That's a lighter audit. It's like a light audit where somebody is basically saying nothing's come to our attention that these are incorrect. They're not saying they're correct. They're just saying nothing's come to our attention. And so if you're between $250,000 and $1 million, you can get a review done. Earlier in this session, we just touched on sort of the cost of an audit. I think $2,500 upwards. Generally, I haven't seen audits done for less than $2,500. For a branded audit, you know, a firm like ourselves, they'll probably range from about $7,500 to $10,000 up. So they can be expensive. So you just got to be mindful if you are in that $1 million space, there will be a cost to do an audit, and it's a mandatory requirement. So we'll park that there. Next slide, Bo. So the compliance obligations, you need to report to Consumer Affairs. they say your financial statements must include an income and expenditure so your profit and loss or income statement, your assets and liabilities being your balance sheet, and then other documents required by accounting standards. That other document is your cash flow statement and the notes to the financial statements explaining what's happened. The compliance obligation when you prepare your financial statements is that you need to report that under an annual general meeting. Generally, they need to be held within 5 months after the end of financial year. And then after that AGM, you've got 1 month to lodge it with Consumer Affairs. Now, COVID can sometimes, what we saw last year, COVID, there was some extensions granted. The other thing just to bear in mind with AGMs too is in the COVID world, a lot of them were virtual, but people's model rules of constitution actually said they had to be face-to-face. So you just got to be careful when you're holding your AGM that you can do those virtually. I'll just sort of add that fact. I'm sorry, I'm just speeding through this. The other piece of compliance then just to consider, Bo, do you want to go to the next slide, please? Is where you're paying payments to players, coaches, umpires. It's really important you get one of these statement by a supplier signed. Basically, it's saying generally that this is it used to be called a hobby statement. What it means is the club wouldn't get caught with the requirement to withhold PAYG withholding on those payments. So these are really important documents to make sure you're getting from anyone that you're paying, basically from what we see in a lot of clubs, the bar sales, you might then pay the umpire out of the till, you might pay the players out of the till. If you're doing those type of things, you need to make sure you've got these statements in place. And Bo, just the last one. The other thing we want to just touch on is income tax. So within the Income Tax Assessment Act, a club basically self-assessed whether they are exempt for income tax. And that assessment applies to, we've said here, a not-for-profit society, association or club, and it needs to be established for the encouragement of sport, a game or animal racing. It can't be a registered charity. It complies with the substantive requirements of its governing rules, so your constitutional model rules, and it applies its income and assets solely for the purpose in which it was established, which is in the model rules. So if you tick those boxes, generally you're income tax exempt. Some clubs can get themselves caught here where they branch out into more business dealings as opposed to the operating to be established for the encouragement of sport, a game or animal racing. So if we look at some big clubs, if we look at an AFL club, we'll generally see AFL club and they'll have an entity to the side that might run the pubs or the pokey venues. Yeah, because to them, that's not the encouragement of a sport. So they break that element of their business out to a separate entity that pays tax. So you've just got to understand if you do something that might move away from that encouragement of sport and that becomes a primary focus of the club, you may be jeopardising your income tax exemption. And that was it for me. Sorry for speeding through. I was trying to get to 8:30, but happy to pause now for any questions.
I just wanted to ask about the statement by a supplier. I was aware of it with regards to, say, for example, a coach, but your example of an umpire requiring it as well, we pay a lot of people who kind of just put their hand up at the game and agree to umpire at the lower grades, obviously. Hockey Victoria organise our Premier League level, but would we have to get that filled in for those people as well?
Yeah, it's a really good question. And so the technical answer here is yes. So you're paying anyone, the technical answer here is yes. I think it is a common practice you see in a lot of grassroots and community sporting clubs. And have we ever seen the ATO take compliance activity? No, I've never seen it. However, if I took the reading of the Act, if you pay somebody and you don't hold one of these, or they haven't issued you a tax invoice, or they're not an employee, you must withhold the relevant withholding rate, which is 48.5 cents in the dollar, I think.
47, yeah.
47, yeah. So, yeah, you got this technical piece that it's best practice to have one of these to protect the club.
Perfect. I think the next slide, Bo, just to go, is just some resources. So again, these will be within the pack that we send out, but there's a range of different ones from a financial perspective. CPA Australia's got some great ones. It mentioned a few times, obviously, Consumer Affairs, that they've actually got some really user-friendly and pretty kind of plain English kind of guides as to not only from a financial and accounting side of space, but from governance as well. It's got some really useful resources there. And then from the sporting lens, Club Help website we mentioned the other night, that's our website with some great templates and information. Vic Sport's got some good ones as well in the ATO in terms of income tax exemption and the statement by supplier that Paul mentioned before. So a range of different resources that you can utilise from tonight. The very last slide, obviously next session, as we said before, the 28th of October, again, we'll be here on Teams starting at 7 o'clock, really looking into financial sustainability. So some of the lessons learned, I guess, from the COVID period and really looking to bounce forward as much as we can as clubs. So really looking at the crisis itself and what we've seen and how does your club stay financially sustainable? Are there some alternative income streams, and going into a bit more detail around that? So some tips for managing finance generally. A bit of it's covered tonight, but within those kind of general finance practices, what are some good tips around it? And then that tipping point for viability, it's an important one to be able to consider is to when are you at that dangerous level that you've really got to start putting some time and effort into helping your club. And yeah, as I said, the 28th of October, that's that session. And if you've got any questions in the meantime, please feel to send it through. Otherwise, we'll get the resources through to you tomorrow. And More Australia will be delivering that session as well, which would be great to have them back for that. All right, well, that's it. Thank you very much to Bo and Paul from More Australia for presenting tonight. We hope you really took something out of this session. And as we said, there'll be a range in terms of background and understanding of financial literacy coming into tonight's session, but we hope each of you have been able to get some different points that will help you in your club environment. And we really look forward to seeing you for the next session.